Okay, it is Wednesday, May 17th, about noon Eastern time. For those that are joining us for our monthly town hall today, welcome. We'll give folks a few minutes to sign in and join us. Welcome to the Copperleaf Financial May Town Hall. And our topic today is really the science of sustainable investing. And I am so thrilled to have Lacey Hubel as my guest today. Lacey, I hope I pronounced your last name correctly. Correct me if I'm wrong.
Hubel. I've heard a lot of variations, but yeah.
Thank you. I've always called you Lacey. Lacey is the head of responsible investing North America and senior portfolio manager at Dimensional Fund Advisors in Austin, Texas. So Lacey is joining us from Austin today. Lacey has been with Dimensional for over 10 years. And I am super impressed. Lacey has accomplished things that I could never accomplish. She has a bachelor's degree in mathematics and 2 master's degrees in mathematics, which impresses the heck out of me, and is a chartered financial analyst in addition to all of her other skills and responsibilities. So today I want to remind everybody, first of all, thanks for joining us. Our session today is co-sponsored by VBSR, Vermont Businesses for Social Responsibility. We're very excited about that partnership with VBSR. This session will be recorded. We'll spend an hour really chatting about the topic of the science of sustainable investing. The recording will be posted on our website, usually within about a week, probably sometime next week. And we encourage questions. So those of you that are on today, please, if you have questions along the way, please enter them in the chat, and we'll get to them as we go. So Lacey, once again, thanks for joining us today. And I suppose I should remind people, let me just take one quick step back. My name is Michael Thompson. I'm partner and senior wealth advisor here at Copperleaf Financial. We are a wealth advisory firm here in Williston, Vermont. We help clients all across the country with really holistic and sustainable wealth management and financial planning. And yeah, so let's kick it off. So Lacey, why don't you, we have a big topic today, and sustainable investing and ESG is really in the news in all kinds of ways today, but maybe let's take a step back a little bit and try to define what we're talking about. When we talk about ESG or sustainability, what should we be thinking about? What does that mean to you, and how do you think about that?
Absolutely. Thanks so much, Michael. And I just want to start off by saying, of course, it's always great to get to talk to you, and I'm definitely excited that we get to do so in this venue today in the town hall. So I've been looking forward to this. It's great to be here. But yeah, absolutely. I think that's such an important place to start any conversation on ESG investing, sustainability investing, because if you ask 20 people what ESG investing is, you'll get 20 different answers for very good reasons. So at the really the highest level, so the E, the S, the G in ESG investing, E stands for environmental, S stands for social, G stands for governance. So how a company runs itself, its governance practices. Mm-hmm. So ESG investing is generally thought of taking specific environmental, social, or governance considerations into account in the investment process in these generally specific ESG strategies. But just by nature of those words, you can see that this is an incredibly broad topic. Yeah. So just the E, environmental, that relates to every way that the company can impact the environment and every way that the environment can impact the company. So there's so much there. The social, how companies interact with their employees, with their vendors, with the communities in which they operate, with the world. These are also just so much goes into this one aspect. And then governance, probably the ignored sibling of ESG, but a very important aspect of ESG investing. how a company is run. Does it have an experienced board of directors who has the company's as shareholders' best interest at heart, that is working for long-term goals for the company and those who invest in it? So a lot goes into ESG investing, and can absolutely mean different things to different people. People have different priorities, different preferences, different beliefs within each of those topics, and can incorporate them in different ways within their strategies. And all of those strategies would be ESG investment strategies.
But that's so broad and can be, and because of that, can not only be confusing, but can be pretty muddy. So one of the things that we appreciate about dimensional and dimensional sustainable funds for our clients that are interested in aligning their investments with their values, we do use dimensional sustainable funds for the core of our portfolios, but we do that for a reason, and maybe kind of pick it up from there, and let's kind of start digging into what do you mean maybe by the science of sustainable investing, and how does dimensional define it? Because again, when I look at the kind of the landscape, the overall landscape, if I were an individual investor or a consumer, I would be so confused, and I wouldn't know what was legitimate and what was just, somebody trying to paint a green face on what they were doing. But how do we know that that's not what we're getting when we're looking at dimensional?
Yeah, it's incredibly confusing. It's a very complex area, and one that gets a lot of attention, as you mentioned, a lot of press, but also a lot of interest. A lot of people are looking for environmental or other ESG types of strategies for reasons that are incredibly important to them. We're talking about people, as you mentioned, aligning their investments with their values, their personal set of beliefs, values, convictions. So these are incredibly important topics, and you want to make sure that they're being meaningfully addressed within the investment strategy. So it's difficult to navigate, but important to do so. How we look at ESG investing at Dimensional, as you mentioned, is that values alignment, aligning investments with values. And I could even just talk a minute about that, because it is an important distinction. There are other reasons that people might choose to invest in ESG strategies as well. I think a really good example is when you talk about the difference between investing in ESG strategies in order to protect against specific risks versus investing in ESG strategies in order to align with your values. A good example of that is if you're looking to avoid investing in companies, or in the case of bonds, in governments that are more subject to ESG risks. Let's focus on sustainability. So you're looking to avoid companies that are more susceptible to sustainability, environmental, climate change risks. You'll avoid a certain type of company or government, maybe a hotel that's on the shore, maybe a country that's more reliant on traditional agriculture, that has more of a sea level type of geography. Whereas we're looking at ESG investing as a way to align with values. So we're looking to avoid those companies and countries that are doing the most harm from a climate change perspective. So looking to avoid or reduce exposure to those companies, those countries that are producing more emissions, that are making less efficient utilization of natural resources, that are producing leaks of methane, other harmful gases. So I think that's important to start off with, as we're looking at ESG investing as a way to align with values. And as these values are so important to people, now we want to incorporate them in a meaningful way. And so we have to bring science into the conversation, which I think is pretty fascinating, because there's very rare instances where you're trying to combine people's personal convictions with scientific research and evidence. But this is one of those places. So we look to investors, we look to advisors, our conversations with advisors as well, about what are you hearing about on the ground? What are people concerned about? Why are they coming to sustainability portfolios? And then we work with the scientists as well to make sure that we're reflecting those values in a way that's really meaningful, is having an impact on the sustainability characteristics of the portfolio, and that we're doing so in a way that's really transparent. so that investors know that we're taking those topics that are most important to them into account in their investments. And we're doing so in such a way that they can see the results. So generally, in terms of sustainability, we hear about climate change. So of course, the focus of our sustainability strategies is reducing exposure to carbon emissions. And then we're able to produce reports that demonstrate the reduction in carbon emissions of our sustainability strategies.
Yeah.
So being clear about what we're doing, making sure that's aligned with investors, which of course is a big part of the conversations that we have with you, with other advisors, and then making sure we're able to provide clear reporting so investors feel comfortable that their investments are in fact in line with those values they seek to implement.
One of the things that struck me and I found very compelling about Dimensional's approach to sustainability is really back to those roots of the science. I know that you guys looked at kind of the whole issue of climate change and tried to determine how might an investor have an impact on climate change. Tell me if I'm wrong, but I think this story is kind of what I've heard before, and that carbon emissions was one of the things that there was data to really support, and you could really focus on how do you screen for, or how do you understand the impact that companies are having from a carbon emissions or from a CO2 standpoint. Can you talk a little bit about that? You kind of tell us a little bit more about that science and kind of how you approach that from a climate change standpoint, and how you kind of settled on that approach.
Absolutely. So we actually started managing sustainability strategies about 15 years ago.
Yeah.
So certainly climate change can be, unfortunately, a divisive issue currently. It was even more so 15 years ago. So starting to work with the climate scientists and really identify the reduction of carbon emissions as the best way to align strategies with those particular values is something that took some work. That we, these days it's pretty straightforward. But inception of the portfolios, it was a different story. So, but then it was a lot of work with, we work with Scripps Institute at San Diego. They do so much fascinating work. We work extensively with professors out there on understanding the science and understanding ways that we can, again, reflect these values in, as you mentioned, ways that are really clear and have solid data behind them. There's so many issues, so many topics that people are concerned about. But if you don't have the data to really identify those companies that are having the most problems with those particular issues, you can't incorporate it in a strategy, or you can't do so in a meaningful way. If there's a topic someone really cares about and there's the data there is a little bit wishy-washy, you could say you're incorporating that belief within the investment strategy using this suspect data, but that's not really our approach. We have a much more scientific approach. We want to make sure that we're addressing topics we believe the data is strong, and we are making a meaningful impact on that particular topic. So within climate change, carbon emissions, a lot of companies, around 80-90% of the U.S. and developed markets universe report their carbon emissions. And that's only growing as, especially as regulations increase requiring companies to disclose their emissions. So we're able to get great data on companies' emissions. We can compare companies on their carbon emissions. We can emphasize those companies with lower emissions relative to other companies in the same line of business. So if there's a couple of tech companies and one of them is more on renewable energy, making more efficient use of how they are their data storage warehouses, that's going to show up in this very clear way. And we can incorporate that within our strategies to emphasize those companies with more sustainable business practices and de-emphasize or exclude those companies with less sustainable business practices. But your portfolio is only ever going to be as good as the data that goes into it. And that's a really important aspect of what we do.
Which I think is another really important point, and one of the reasons that we were drawn to Dimensional to begin with when we were looking at a solution for our clients around sustainable, around ESG, because we know how committed Dimensional is to research and to data and to really following the facts and following the evidence. but many of our audience may not be aware of that. Could you just kind of help us take a step back and understand, for me, it's sort of obvious how committed Dimensional is to research and to the data, but maybe if you don't mind, can you paint us a broad picture or an understanding of Dimensional's history and how committed Dimensional is to research? And I think you guys have got a few PhDs on staff there, right?
We do, and a couple of Nobel Prize winners on the board. Yeah, I think, I mean, it might even be interesting, just a history of investments. Back in originally in investments, your only option is picking individual stocks.
Right.
And you hope they do well. The upside is if a couple of them do well, you're going to do pretty well. That's great. The downside is if a couple of them do poorly, it's really going to impact your overall portfolio when you have a small number of holdings.
Yep.
So that really changed in the 70s, where now you can invest in the market. You can invest in a lot of companies. And if a couple of them don't do well, that's okay. And it's great to be invested in the market, because over the long haul, the market does pretty well. And advisors like you and many others understand the importance for your clients of diversification, of having a more reliable investment experience. This is an approach that changed the world for people like us. And then in the 80s, I guess that's when Dimensional kind of found that middle ground, where we still hold most of the market. We hold a lot of it in a way that you can get that more stable, reliable investment experience. But we do so while we tilt the portfolio towards those characteristics that you can identify as being more likely to do better. So there's certain financial characteristics that over the long haul do better than the market, and we'll emphasize those characteristics in our investments. So pretty straightforward, but a ton of research behind that, both empirical as well as theoretical. A lot of research goes into this, and the folks who did that research, Jean Fama, Ken French, these are folks who are really closely associated with our company, Dimensional, who sit on the board, who are part of committees, who still guide what we do today. So we really started in the University of Chicago Business School, really, and it's still a part of our approach. People talk about, the first time you're sitting in the cafeteria, and people you read about in your textbooks are walking around. It's a pretty humbling experience to be here, but our approach has always been focused on scientific research, on solid data, and it's something that carries through what we do in investments today. It carries through what we do in ESG. It carries through every aspect of what we do as a company.
And the distinction for me is also that's when we're talking about research, we're not talking about proprietary Wall Street research. We're really talking about academic research. We're really looking at peer-reviewed academic research that's really in my mind, and I grew up in an academic family, sort of the purest source, the purest kind of empirical research, and really looking at the data, looking at the evidence, and that's what I really appreciate about Dimensional. And how do you apply that back to sustainability? So you talked a little bit about the science of climate change and tapping into the expertise of client scientists to find out what are those factors in terms of carbon emissions that you guys can focus on your research in order to do screens. But do you also use some of these other academic factors, some of these other evidence-based approaches to investing as an overlay? Or in other words, how do you kind of combine sustainability with the overall evidence-based approach?
Yeah, and that's an important. I think that's what really differentiates us. There's a lot of ESG strategies out there, but I think how we combine investments with the approach to ESG is something that stands out in the landscape. So having that approach to ESG, as I mentioned, that's meaningful, has a meaningful impact on the characteristics of the strategy, the environmental characteristics of the strategy, but not doing so in such a way that we're limiting the investment experience. Investments, these sustainability convictions that people have are, of course, incredibly personally important to them. But so are their investments. Their investments are their legacy, what they're leaving to, what they're using to spend themselves, what they're leaving for future generations, for charitable organizations. This is all incredibly important, and we can't sacrifice one in seeking the other, and we don't have to. We incorporate the sustainability considerations in a way that does have a meaningful impact on the universe, but isn't eliminating so much of the universe that we can't implement the same type of investment approach we would use in any investment strategy. So really finding that balance is an important part of what we do at Dimensional, our sustainability strategies, between having that impact on ESG values, sustainability characteristics, while still giving ourselves that big universe with a lot of flexibility to emphasize segments in the market based on financial considerations. And to be really flexible in how we trade securities, which is an important part of keeping costs low, which everyone appreciates.
We have a question which we'll address here. So Jennifer asks, in addition to paying attention to greenhouse gas emissions of companies, do you look at how companies, particularly financial institutions, interact with the fossil fuel industry? Can you speak to your strategy regarding investments in the financial industry related to sustainability? And can you also speak to how you look at equity as a component of sustainability? So I'm not sure if that means gender equity or financial equity, but Lacey, what are your thoughts?
Absolutely. So I think the first question is, definitely an important aspect of how we look at ESG right now, generally, societally. It's also a relatively new way of looking at different aspects of how companies align with sustainability considerations, sustainability values. The data is improving. This is a good way to phrase it. I hope it's something that we'll be able to take into account in our sustainability strategies in the future. But currently, our research group has looked into data around trying to assess how much of financial institutions' money is tied into the fossil fuel industry, tied into various aspects. And it's something that's really difficult to disentangle. There are many groups that are looking to estimate those types of values, and I think they're doing as good a job as they can right now. I think we're going to get more and more insight just based on what we're seeing out of the current regulatory environment. I imagine companies are going to be more and more required to disclose those types of investments they're making, and that we'll get better clarity into that. Once we have that solid clarity, it's something that we could then look to incorporate within our sustainability strategies as a way to assess financial companies. Because as you bring up, it is really important to look at industry-specific considerations. There's different ways that financial institutions interact with the environment than utilities companies interact with the environment. So it's certainly an important distinction to make, and I think we're only moving towards more clarity in data and a greater ability to be able to incorporate those kinds of considerations and strategies in a meaningful way.
Yeah, it's not just about fossil fuel companies, is it? It's about really emissions across the economy and across the spectrum. And also, do you guys look at kind of current emissions, but also future? How do you think about kind of future emissions or future, carbon? Talk about that a little bit, because I imagine there are lots of different things to measure. How do you approach that?
Yeah, absolutely. And there was something I wanted to mention about the first part of what you said, but then I forgot about it. So hopefully it'll come back to me in a moment of brilliance. But no, but as far as future emissions, as with many things, companies' current emissions are pretty much the best predictor of their future emissions. Unfortunately, I think we are seeing a lot more of an adoption of net zero type principles, where companies are looking to reduce their emissions over time and eventually get to a net zero type of place. But those statements that companies make aren't always tied to what we see in practice. unfortunately, and there's also a lot of ways for getting these false this false appearance of a reduction in emissions. You may have heard, not you, Michael, but folks may have heard of carbon offsets,
Yeah.
which is a type of instrument you can buy to offset your emissions. You pay per ton of carbon emissions, and you're investing in these projects that are looking to reduce emissions, which in principle is excellent. In practice, you can buy some of these offsets at 25 cents for a ton of carbon. And you can probably guess that if you're paying 25 cents to offset a ton of carbon emissions, you're probably not offsetting a ton of carbon emissions. So companies can, pay $100,000, very large companies pay $100,000, offset all of their emissions, and market this as they're completing this net zero initiative. So it's really hard to get a concrete idea of what companies are actually doing to reduce their emissions. Again, it's a place we would love to see stronger data, but we just, in the current environment, really don't have that kind of insight.
Mm-hmm. In addition to CO2 and greenhouse gas emissions, what are some of the other screens or some of the other elements of sustainability within Dimensional's approach? What are some of the other things? I mean, do considerations like child labor or cluster munitions, things like that ever come up? Is that ever part of the conversation?
Absolutely, yeah, and those are always evolving. It's I guess it's kind of an unfortunate cycle where a very large, detrimentally impactful event will happen, and then our interactions with advisors will really be focusing on those topics, and will frequently lead to a new screen in our sustainability strategies. So these ongoing conversations have really been helping us as we evolve with what people are looking for, because that's what we're delivering with these strategies. Mm-hmm. So some of our recent screens that we've added are: we exclude companies that are involved in private prisons. We exclude companies that are involved in civilian firearms. So these are some of the more recent. We exclude companies that are involved in palm oil, which has really devastating environmental consequences. The production of palm oil. Generally, there's sustainable palm oil. Look for it. Shout out. But so these are some topics that we do have exclusions for more recently. Mm-hmm. Some of the types of things we've been excluding on since pretty much the beginning of these strategies are, like you mentioned, child labor, controversial weapons like cluster munitions and landmines, tobacco, practices that have long since been criticized, especially by proponents of sustainability strategies. So we're absolutely looking for values alignment with investors, and these conversations are how we do that. As long as investors want to see this topic a part of the strategy, we believe the data is solid, and we believe it's not going to impact our ability to provide an investment experience that we aim to provide. Mm-hmm. And we don't believe it's going to interfere with the focus on environmental sustainability. When all of those things come together, we have a new screen, and it comes out of these kinds of conversations.
And what about investor advocacy? I know I don't know, maybe you can tell us. It's been a long time since I looked, but how much money does Dimensional have invested in sustainable funds? And after you answer that question, I imagine it's more than a couple of dollars, and it might amount to a voice as investors for boards and other stakeholders at companies. So my question that I'm eventually going to get to here is, from an advocacy standpoint, what approach does Dimensional use as an advocate for sustainability practices? But let's start with the first question. Does Dimensional have a significant investment in sustainable businesses, and what's that look like?
Sure. So our sustainable strategies have definitely been growing, which is good to see, because in the overall landscape in the U.S.,
Mhm.
we have seen a bit of a decrease, some outflows from sustainability strategies, but at Dimensional we continue to see inflows. Our investments are somewhere in the neighborhood currently in assets under management and sustainability strategies around $15 to $20 billion. So
Mhm.
absolutely a significant amount invested in a more sustainably minded approach.
Mhm.
And I believe it can have an impact in terms of advocacy. I think it's hard to prove out. So I wouldn't swear. I wouldn't say there's any evidence behind it. And of course, as we've talked about, I'm a little hesitant to talk to things where we can't find this clear line.
Mhm.
Um, but as long as there's a sufficient amount of investors who are investing in a similar way with similar beliefs, it's easy to believe that there would be an impact from that, at least in mass on companies, what's called cost to capital, how much it costs them to raise money, either
Mhm.
through putting out stocks or sending out bonds. I think it is something we might talk about, but honestly, there's, of course, a bit of an anti-ESG movement in the U.S.
Yeah, talk
and
about that.
currently, and if anything, I think that itself is evidence that ESG investing has some kind of impact, because if it didn't, then why would people be so opposed to it? It
Mhm.
seems likely that companies are starting to see an impact, or they believe there could be an impact on their cost of capital from the number of people who are going into ESG investment strategies,
Mhm.
which is leading to a bit of a backlash against this kind of against this movement, which is unfortunate. But if you want evidence of impact, that might be it. Um, I think we've definitely been seeing a growth in interest in these strategies, which is something I personally find to be a point of optimism for myself.
And so, what's Dimensional's position as shareholders for companies? Are you ever attending board meetings or voting on particular issues that might be presented to the board? Kind of, what's your approach to that?
Absolutely. It's such an important aspect of being a shareholder, and we absolutely do a ton of work to make sure that we're best representing investors' interests
Mhm.
as shareholders.
Mhm.
So we definitely engage with companies. We vote proxies. Last year we voted over 130,000 proxies.
Wow.
We conduct 500 to 1,000 engagements with companies a year, and that's not sending an email. That's meeting in person, ideally with members of their board, sometimes with members of their engagement group within their organization. We focus our interactions with companies where we believe we can have the most impact, which is generally going to be smaller companies.
Mhm.
Sometimes we're reaching out to companies who haven't talked to an asset manager before, and we can be a pretty loud voice in advocating for board oversight of what we believe are material risks for investors, which absolutely include material environmental risks.
Mhm.
Um, We've, in behalf of our sustainability strategies, we'll take it a bit further, vote on more environmental social proxies, we'll engage more with companies, we'll vote against directors of companies in carbon intensive sectors where they have not yet set an emissions reduction target.
Mhm.
So there's a lot of ways that we interact with companies as shareholders, or as representatives of the shareholders who are invested in our assets, in a way that is aligned with protecting their value and respecting the values that they've indicated by selecting specific sustainability or social strategies.
Good. That's what I thought, and that's what I was looking for. Definitely an active role in meeting with companies, meeting with boards, and other important folks at companies to advocate for investors on behalf of some of these strategies, in particular greenhouse gas emissions, climate change, and some of the other factors that we talked about. I want to remind the audience that we are taking questions. If you have any questions, please pop them in the Q&A, and we'll be able to get to those as we go. let's talk a little bit more about impact. I know that I have seen over time, Lacey, you guys have reported, compared to a benchmark, maybe the S&P 500 or the broader index, some of the funds have a measurable impact on greenhouse gas emissions. Can you speak to that a little bit? And is there how does an investor measure the impact that they might be having with their investments in dimensional sustainable strategies?
Definitely. So the the focus being on reducing exposure to carbon emissions, fortunately makes it quite easy to get clarity into what impact the environmental considerations are having on the characteristics of the strategy. So we can we'll take the emissions of every company that's being held, find the weighted average, and that's your exposure to carbon emissions. Generally, we're going to be scaling that to make sure that it accounts for size. A very large bank is going to have higher emissions than a very small oil company, but that doesn't give us any real insight as to each of their impact on the environment.
Right.
So we're generally going to be scaling the emissions by something like a company's revenue. And we can report on what the average emissions are of our sustainability strategies compared to the average emissions of the benchmark. Our strategies vary in how much they reduce the exposure to emissions because markets vary, because your approach has to vary a bit in order to make sure you're still providing the same investment experience regardless of the market. But generally reduction of, let's say, 65 to 90% compared to the overall market. So
Wow.
really significant reduction in exposure to emissions in these strategies, and something that investors generally who are in these strategies find to be incredibly important, and feel not only good about that result, but also good that they can see that result.
Yeah. Thank you. That's really helpful. And at one point I've seen kind of per $1 million, the total sort of tonnage of greenhouse gas emissions. I don't know if you have that off the top of your head, but those are at least what I've seen in the past have been some impressive numbers.
Yeah, I mean, I probably know it for our fixed income strategies because my history is in the bond markets, but something about going from maybe 250 tons of carbon per million sales down
Mm-hmm.
to 20.
Mm-hmm. Wow.
So it really, really significant. And without there's ways you can do it without taking financial considerations into account.
Mm-hmm.
And then there's the way we do it, where we're still able to target those segments of the market that are more likely to outperform.
Mm-hmm.
Some of them are found in the oil companies,
Mm-hmm.
but many of them aren't. So
Mm-hmm.
we can exclude or underweight oil companies, but still target those characteristics that are likely to outperform. So really being able to combine both in the dimensional sustainability strategies is I think really a crucial aspect of them.
Yep. And you guys have really kind of cover the globe and cover asset classes, because I think a lot of times investors think about U.S. companies and maybe that's the easiest kind of the easiest data to access, but you also have international strategies and emerging market strategies and fixed income, as you said. How do you get at the data when it's sort of not U.S. based? How do you get at data that might be from emerging markets or even global or international? Is that a challenge, or I just spend too much time in the US these days?
I think I spent too much time in the US as well. But so actually, 10 years ago, maybe US by far had the most companies reporting on environmental characteristics like emissions. But actually, we've been passed by Europe recently. So global developed strategies, which have a lot of investments in Europe, actually have an easier time finding data than US strategies these days. Though they're both, they both have significantly high numbers of companies reporting, but a bit higher in Europe. Emerging markets, it's certainly more challenging. There's especially specific topics that are harder to get data on, like involvement in child labor practices, for example, other screens that we exclude on quite easily in US and developed markets that can be a bit challenging in other markets. Generally, with carbon emissions, we can look into, but primarily data providers who are experts in this kind of thing, can look into companies' line of business, where they derive their revenue, and then use that combined with other companies that do report their emissions in order to estimate with as best they can the emissions of various companies. So those companies that don't report their emissions, we're still able to get pretty good access, a pretty good estimate of the emissions of those companies. But the coverage definitely varies by area of the world. And fixed income, it's surprising, but to many people, but there's great coverage in bond markets, even among private companies, which are companies that don't issue stocks, but they do issue bonds, so we can buy the bonds of those companies. Generally have fewer reporting requirements, but we still have really good coverage within the overall bond market of companies' emissions. So we're definitely always moving towards more clarity in this space, and absolutely excited to be taking advantage of that on behalf of investors who really care about these topics.
Yeah. I want to focus a little bit more on kind of the idea of sort of anti-ESG these days, but also the topic of greenwashing, because I think, the growth of interest in ESG and sustainable investing has been phenomenal over the last 20 years. I mean, it's when I look at a chart of kind of the growth of assets into these types of investments, it's like a logarithmic chart. It's incredible how steep the slope is. It's massive. But that sort of leads to, like you said, this backlash. And in backlash, in one way, I think of as sort of greenwashing, companies that may be representing strategies that, how do you know if they're really an ESG or a sustainable approach? So I'm going to ask a multi-part question here. and the other is, maybe has some of that led to this kind of this anti-ESG movement, I wonder, but let's talk about greenwashing a little bit. And I don't know how much you can speak to what other companies might be doing, but what do you see, and kind of what's your perspective on that? Do you have any insight there?
Yeah, I think the backlash against greenwashing is definitely something that's really understandable, really reasonable, and makes a lot of sense. As you said exactly, we saw an incredible growth in the amount of investments in ESG strategies, and of course, the market is going to look to accommodate that by providing a lot more ESG strategies.
Yeah.
So you've seen a ton of ESG strategies just crop up in the past 5 years or so. And it can be a mixed bag, right? So it's good to have more choices, of course, but it can certainly be difficult to navigate when this field is so broad. So you have 100 different ESG strategies that don't overlap at all in their investments. They each have completely different investments. Some of them will even say they're targeting the same things and have completely different companies they're holding.
Right.
So how do you assess whether these funds are doing what they say they're doing? And that's where you come in. But it's also something that investors want to be clear on as well, right? You want to have a way to assess it yourself. Funds are required to produce these documents that are incredibly boring, called prospectuses that I spend a lot of time reading, and have a part in editing as well, where we describe the key objectives of the portfolio and hopefully do so in a way that is very clear. So investors can see, okay, this strategy is focused on affordable housing, or this strategy is focused on reducing carbon emissions. This strategy is focused on clean water. Whatever the focus may be, it should be outlined really clearly in those kinds of documents.
Mhm.
And then the fund should be providing reports on those specific topics that are laid out in the prospectus that really clearly indicate that those characteristics are being addressed. So if you say you're trying to improve access to clean water, there should be a really clear report demonstrating that improvement, that reduction in specific types of water pollution. If your focus is on affordable housing, again, clear reporting there. And then on carbon reduction, as we've talked about quite a bit, a report showing the carbon reduction. So it's important to tie out reporting that the funds are doing with the clearly stated objectives, and trying to tune other aspects out, I think, is important as well.
Yeah. We talk about anti-ESG, and I think some of it may be, when I think about it and read some of the press, and I think about greenwashing and sort of the popularity of kind of all things green. I don't think that's it's natural, I think, that people can be skeptical of kind of where that's coming from or what that means. And one of the things that we appreciate, or that I appreciate about what you guys offer, is a choice. And it's really, to me, it's all about capitalism and giving investors choice about where they put their money, how they spend their money, and how they deploy their capital. And I think at the end of the day, markets are kind of smart. And money tends to flow to companies that are doing well. And this is my perspective. Correct me if I'm wrong, and I'd love your perspective on this too. But if a company's transparent about their environmental impact and transparent in reporting about their carbon emissions, and maybe their hiring practices, and the gender equity within the company, and other practices, that might be appealing to investors. And it also may represent less risk from an investor if I know more about what the company's doing. And that's kind of how capitalism works, right? What's your thought about that?
I really couldn't agree more. I think as far as the different movements around ESG investing, obviously I support choice. I don't think investors should be forced into specific ESG strategies, and I don't think investors should be forced out of them. I fully believe in choice around what investment works best for specific investors, and and if they would like their specific values reflected in their investments, I support their choice to do that as well. And I think it's really important not to lose sight of the importance of choice around this. I think I feel like in maybe 20, 30 years ago, it was really there was a big mindset about not diving into your investments too much. People didn't know a lot about them and didn't realize how much control they had over them. They would just pick this option, stick with it. But more recently, we're seeing people who want to know more, who are asking questions, want to understand, and realizing they have the power to direct certain things. I'm adamantly opposed to this particular sector. I don't have to have it in my investments. I think there's great quotes on the topic. There's great TED Talks on the topic. But I think in general, when you're invested in a company, I mean, you can think about what the term invested means outside of investments. If you're invested in your local sports team, you're invested. These are things that you're supporting. When you're invested in a company, you support them. You want them to succeed at whatever they are doing. And if there's a particular value of yours that you just can't wrap your head around this, you don't want to be supporting this company in this particular line of business, you don't have to. There are choices out there, and you can direct your investments in a way that's more in line with your personal values. And I think the importance of that can't be overstated. So I definitely believe in the importance of choice there. I think there was a second part of your question as well in terms of ESG investing.
No, it's okay. I think you hit on it. I mean, it used to be you touched on this a little bit, sort of history of sustainable and socially, what we used to call socially responsible investing. I mean, it used to be it was sort of a given if you wanted to invest your values in a way that was excluding certain companies, tobacco companies or maybe oil companies, or in the old days, companies that were invested in South Africa and apartheid. It was a given that you were going to give up return, that you may be giving up return, but that was a choice that you made. I guess what I'm wondering today is how much is that true today? If someone chooses to invest in a dimensional sustainable fund, for example, since that's what we're talking about today, is it a given? Is it understood that one is going to be giving up return, or is that not necessarily a choice? What are your thoughts on that?
Absolutely. So I believe that the types of factors that go into long-term performance, you can target those the same way in a sustainability strategy that you do in a non-sustainability strategy. Yeah. So over the long haul, we would absolutely expect similar performance between a sustainability strategy and a non-sustainability strategy. Of course, there could be small differences. You have a slightly different universe, a slightly smaller universe in an ESG strategy as you do in a non-ESG strategy, but that difference is very small, and you're still able to target those known financial characteristics in the same way in a sustainability strategy you would in any strategy. Additionally, on shorter time periods, you can again see some differences. I think a good example of those differences, very recent, in 2020, 2021, the energy sector tended to not do very well. So sustainability portfolios generally had very strong performance relative to non-sustainability portfolios. Then 2022, the energy sector rebounded and non-sustainability strategies did significantly better than sustainability strategies. But over that entire time period, they performed about the same, just a little short-term fluctuation. So after that period of time where sustainability strategies were outperforming, you'd hear a bunch of folks on one side of the equation coming out saying, see, sustainability strategies are so much better than non-sustainability strategies. You can expect to outperform. Then the next year, energy does well. Now you've got the folks on the other side coming out saying, see, sustainability is a terrible idea. Look at last year. Sustainability is going to underperform. Really, the answer, as is usually the case, is in the middle. That over the short term, you're absolutely going to see some relative differences. But over the long term, we, at least with dimensional sustainability strategies, because of the diversification, because the investment approach, we expect long term to see similar performance between sustainability and non-sustainability strategies. And it really comes down to your personal values.
Yeah, I'm looking at just to kind of check the point. I just pulled up on my other screen here. I was looking at the dimensional U.S. Sustainable Core ETF, holds 1,968 companies. So a fairly broad cross section of the U.S. economy, versus the benchmark has 2,900. So about 1,000 companies less than the benchmark, which is probably what the Russell 3000 maybe. So 2,000 companies versus 3,000 companies, but that's still pretty diversified investment, right?
Yeah, absolutely. We're talking about really well-diversified strategies that when we talked earlier about reducing risks and investing in a sustainability way, that you're reducing exposure to certain sustainability risks. as with any kind of risk, diversification is really going to be your first step in trying to reduce your exposure to specific risks. So when you're looking to reduce exposure to certain sustainability types of risks, and there are many, many out there, not just from climate change, but from so many different avenues, and they can come in the nature of physical risks, they can come in the nature of regulatory risks or of legal litigation risks. Your best bet against those types of risks is going to be through diversification, and it's an important aspect of all of our strategies, including our sustainability strategies.
Which aligns perfectly with our philosophy, and one of the reasons we feel like Dimensional is a good partner for us, rather than stock picking, rather than trying to pick a portfolio with 20 or 50 or even 100 different companies. Let's essentially own the market, but screen for those factors, that we know may lead to better performance, and then screen for those factors that we want to exclude, that we want to focus on reducing greenhouse gas emissions and eliminating tobacco and eliminating child labor and civilian weapons and things like that. So that's the approach that we favor, versus trying to pick winners and losers, or simply pick a handful of companies that may or may not give us what we're looking for in the long run. Lacey, we're getting to the end of our time here. I want to remind the audience that please let us know if you have any questions for either of us today about sustainable investing or the science behind sustainable investing. We've really just scratched the surface of the topic, I feel like, today, but I think we've done a good job of scratching. Lacey, as we kind of reach the end of our time, are there things that we haven't touched on today that you think are important for investors to know about either Dimensional's approach to sustainability, or the science, or what you see sort of on the horizon for sustainability or sustainable investing coming down the road?
Yeah, on the horizon, I think is something that I'm always find quite interesting, because this is when you talk about the science behind investing, this is something where there's been extensive research being done since probably the 70s. So we've got 50 years of really solid data, of a lot of smart people looking at data and sussing it out in 100 different ways. When we look at sustainability, it's certainly been a topic of importance for many people for much longer than most people realize. This has been a topic of importance for a long time, but it's something where we're only very recently seeing really good data. Probably in the last 20 years, maybe even 10 years, where we have really solid data that we can reference and invest based off of. So it's a field that's growing just so rapidly relative to other fields and investments. Something that's very interesting. We're seeing so much more insight into how companies interact with the environment, how they behave more sustainably, how they interact with fossil fuel industry. I think something that we were talking about earlier is, within even fossil fuels, do you look more at supply side or demand side? Because as long as people are demanding fossil fuels, there's going to be people pulling it out of the ground. So punishing fossil fuel companies only gets you so far, because as long as people want it, it's going to be coming out of the ground. So starting to, as we do within our sustainability strategies at Dimensional, looking at those companies that are utilizing fossil fuels and penalizing those companies that are using more, not just those that are producing more. You've got to look at both sides of the equation, and we're getting better and better insight into that. We've got good data now. It's only getting better. We're getting more insight into how companies are splitting their business, splitting their revenue between different types of projects. There's choices to be made all over the place, and the more insight we get, the better for investors. And we'll continue to evolve our process. We're making best use of current high quality data to incorporate values in the strategies. And it's going to look different today than it does in 10 years, but it's always going to be with that same mindset of, Dimensional providing sustainability strategies that have this approach to investments that you've come to expect, while aligning with these really important values that people hold very close.
all the things that you've said, Lacey, are some of the things that we really value about Dimensional and the work that you guys do on behalf of our clients, which means you guys are not taking the lazy approach. You guys are so diligent, always focused on the research, always focused on digging in deeper, digging in harder, finding more evidence, finding more data, and constantly improving the approach and the portfolio on behalf of investors. And we really appreciate that on behalf of our clients, because, you know, we could choose to align ourselves with a company that was much more lazy about it and simply kind of picked a portfolio and kind of went ahead. But you guys are the opposite of that. You guys are working very hard at it every day. And we really appreciate that. I want to thank you for joining us today and helping us really focus on this topic, and let our participants know, our attendees know, to join us next month in June on the 19th. My guest is going to be Janice St from the Flexible Capital Fund here in Vermont. Last year, one of the recognized by VBSR for their innovative work in providing capital to Vermont companies. So please join us in June on the 14th at noon for that session. And thanks everybody for joining us today. What a great time. And Lacey, I hope we get a chance to do this again down the road.
Absolutely.
Thanks a lot,
Thanks
everybody.
so much, Michael.